Welcome to this explainer. Today we're diving straight into a historically unprecedented economic setup. We're looking at a convergence of warning signs that, honestly, we just haven't seen flashing all at once since 1929. You know, right before one of the worst crashes in human history, some very specific structural forces aligned. Well, looking at the data right now, those exact same forces are converging all over again.
But here's the thing, the market has been lulled into this kind of false sense of security lately. The warning lights absolutely flashed, but the immediate crash didn't arrive exactly on schedule. So we really have to ask the multi-trillion-dollar question, does a delayed crash mean we're actually safe, or are we just watching the exact same movie play out right before the devastating drop? Basically, is this time actually different?
To truly understand the very real danger we're facing looking into mid-2026, we've got to look at a staggering number. 2 straight years. That is exactly how long one of the most reliable warning signs in all of financial history, a yield curve inversion, stayed active. 2 whole years. That completely shattered the old record from back in the late 1970s, which, by the way, happened right before a really brutal recession.
Okay, let's look at our roadmap for today. We're going to cover 1. The ultimate warning sign. 2. Unpacking the yield curve. 3. Stocks at historic highs. 4. The unaffordable housing market. 5. The Fed's impossible trap. And finally, number 6. The calm before the storm. Let's get right into it.
Section 1. The ultimate warning sign. A signal with 0 exceptions.
See, when this specific signal flashed in the past, life actually seemed totally normal for a while. Usually for anywhere between 6 months and 2 years. People always assumed, oh, the warning must be wrong this time. But then, with just devastating accuracy, it perfectly called the early 2000s dot-com crash, the 2008 financial crisis, and the 2020 pandemic recession. It's that lag time that always tricks people.
Moving into Section 2, unpacking the yield curve. Let's see what bonds are actually trying to tell us.
So the crucial point to grasp here is that a yield curve inversion happens when short-term government debt pays a higher interest rate than long-term debt. It literally flips the normal rules of finance completely upside down. Think of it like the bond market furiously waving a giant red flag, signaling that investors expect the economy to get so incredibly weak that the Federal Reserve will be forced to cut rates hard down the road.
Now, by late 2024, the curve actually uninverted. It went back to normal. But you've really got to notice the difference in how it happened. A bull steepener is a healthy normalizer. It means short-term rates fall because inflation is under control. But we got a bear steepener. That's a highly dangerous pattern where long-term rates stubbornly rise because investors are terrified of inflation and debt. Historically, a bear steepener happens right before the real economic damage actually starts.
And right now, the gap between the 10-year yield and the 3-month bill has flipped negative all over again. In fact, the New York Federal Reserve's own model shows the odds of a U.S. recession in the next 12 months sitting at a 1 in 4 chance. Now, 25% might not sound like a sure thing to you, but if you told a room full of economists they had a 1 in 4 chance of total disaster, yeah, they definitely wouldn't be relaxed.
All right, Section 3, stocks at historic highs, bringing us directly to those 1929 comparisons.
The key metric we need to look at is the Shiller-Cape ratio. It's a highly respected long-term valuation tool that basically smooths out short-term noise by adjusting 10 years of earnings for inflation. The historical average is about 17. The 1929 peak was roughly 32. Today, we're sitting at 40 plus. To put that into perspective, the market today is vastly more expensive than the 1929 peak. The only time it was higher was the final blow-off top of the 1999 dot-com bubble. Absolutely wild.
You might be asking, how on earth can the market justify these eye-watering prices? Well, it's largely due to a massive wave of spending tied to artificial intelligence infrastructure. Just a handful of giant tech companies have almost single-handedly propped up these entire market valuations, and that creates a terrifyingly thin margin for error. If earnings from this highly concentrated AI spending disappoint even slightly, the market reaction is going to be sharp and swift.
Section 4. The unaffordable housing market. Let's talk about how the majority are being completely priced out.
The data here is just staggering. Financial experts generally consider 2.5 to 3 times your income to be a truly affordable home price, which, by the way, was totally normal throughout the 1990s. But today, that ratio has nearly doubled to 5 times your income nationally. And in major cities, it's way, way worse. It's skyrocketed past 11 times a median income in places like San Jose, California. We are just nowhere close to affordable anymore.
Because monthly payments have nearly doubled recently, and affordable rentals under $1,000 a month have essentially vanished, the real estate market is completely frozen. Existing home sales are sitting near their lowest levels in 3 decades. And as a direct result, consumer confidence has plummeted to levels even lower than the absolute depths of the 2008 recession. When regular folks lose confidence and get squeezed this hard, they stop spending, and the whole economic engine stalls out.
Which brings us to Section 5, the Fed's impossible trap. They are totally backed into a corner.
So, a brand new, highly unpredictable Fed chair took over in mid-2026. This new chair relies a lot less on forward guidance and much more on meeting-by-meeting data. But just as they took the wheel, inflation re-accelerated. Driven by Middle East energy shocks, core inflation climbed right back above the Fed's 3% target. That completely wiped out the stock market's eager expectations of those 2026 rate cuts.
And this creates the ultimate impossible trap for the central bank. If the data-dependent Fed keeps rates high, or heaven forbid actually hikes them to fight this sticky inflation, they'll squeeze an already fracturing job market. This would instantly crash a stock market that is currently priced for absolute perfection, and it punishes a consumer base that's already drowning in massive housing costs. There is literally no comfortable path out of this box.
Finally, Section 6, the calm before the storm. Let's look at the unseen puzzle piece.
Did you know there's a volatility index specifically for the bond market? It's basically a fear gauge for government debt. Right now, it's sitting at its calmest levels in years. But history tells us this quiet is super deceptive. The lead-up to both the 2008 financial crisis and the 2020 crash were preceded by this exact same unusual calm right before volatility spiked violently. Think of it like the ocean pulling way, way back right before a massive wave hits the shore.
So, when you pull back and look at the full picture, the ultimate risk becomes crystal clear. Look, any one of these indicators, from the historic yield curve inversion to the Shiller-Cape ratio sitting above 40, could possibly be explained away individually. But that's not what's happening. When you stack all 5 of these extreme structural risks on top of each other simultaneously, all pulling in the exact same direction, you get a setup that arguably hasn't been this unforgiving in a full century.
The ground beneath our economic tightrope is literally disappearing. Yes, the tools and safety nets are different today than they were in 1929, but the structural forces, they're completely aligned. So I want to leave you with this final critical thought to watch for. Will the next inflation print be weak enough to buy the Fed room to ease off? Or will it be stubbornly strong, forcing the rate hike that finally breaks the storm? Pay very close attention to the data right now because the next few months matter far more than usual. Thanks for joining me on this explainer, and keep learning.